Hello class, it's another time we are meeting for our class discussion. In our today's class, I want us to talk about the partnership accounts. The accounts for the sole trader, whereby we say the sole trader is a kind of a business whereby it is owned and managed by a single person. And that same person is the person who enjoys all the profit and all the losses that are incurred in that particular business. For the partnerships, it is a form of business whereby the minimum members in that particular business are 2 and the maximum are 20. So it is a business that is owned by more than one person and a maximum of 20. In that case, we will find that the definition of a partnership is that 1, it has 2 or more individuals. Number 2, it is a business arrangement. That partnership must be arranged in a manner that those partners or the owners of that particular business, they have come together with the purpose of engaging in a business activity. And any business activity will have a profit motive. Another very important thing that you need to understand, the same as the sole trader, the partnership is an incorporated business entity. An incorporated business entity means that there is no difference between the owner and the business. That is to say, if, for example, the business does a mistake according to the rules of the Kenya or the country in which it is established, that particular business, you'll find that now the partners who are the owners will be taken to court on behalf of the business. And therefore, the partners' liabilities are unlimited, meaning that if the business incurs a liability, that liability is the same as the liability of the owners. And another thing is that if a business is unable to pay the debts for that particular business, the personal assets or the assets of the partners might be taken or can be taken, sold to repay the amount the business owes. So what we mean here is that even though we are following the principle of business entity whereby the owners and the business are two separate things, when it comes to an incorporated form of businesses, which is actually the sole traders and the partnership, the liabilities of the business can be transferred to be the liabilities of the owners, as opposed to the incorporated business entities like companies. If a company incurs a liability, the owners cannot incur that particular liability, or that liability cannot be transferred to the shareholders who are the owners. So you need to understand that, therefore, a partnership is an engagement in business where the owners of the business are 2 or more individuals. And those individuals, they have come together to form a business, not any other engagement. And because it is a business, the business is normally established with the motive of making profit. The partnership in Kenya, they are established in accordance with the Kenya Partnership Act of 1962, which defines the relationship which exists between persons carrying on a business in common with a view of making profit. According to the definition, there are following essential elements or characteristics of a business. There must be a business which will be include a trade. Remember, trade here is the buying and selling of goods. It can be an occupation. An occupation here, it can be something like the doctors, it can be something like the accountancy or the auditing, or it can be a profession. The business must be carried with the purpose of making profit. The business must be carried on by or any one individual who is acting on behalf of all the other partners, and there must be an association of 2 or more persons, and the common property or part ownership does not create a partnership. Sharing returns, loan offered or debts does not create a partnership. Up to that point, let us look at the types of partnerships. The types of partnerships. There are 2 main types of partnerships. Number 1, we have got the general partnership and we have got the limited partnership. The general partnership are governed by the Partnership Act of 1962, Cap 29, whereby the partners, which consist of person whose liability for the debts and obligations are unlimited. And anytime you find this word unlimited liability, it simply means that the liabilities of the business can be transferred to be the liability of the owner. So under the general partnerships, you find that the owners who are actually partners of the business, they get or they shoulder the liabilities of the business. If the business is unable to pay a debt of 100,000 and I am the partner together with you, the two of us will have to pay that particular liability on behalf of the business, meaning that the liabilities of the business can be transferred to us, which is now me and you, who are the owners of that particular partnership. Another kind of a partnership that we have is what we call the limited partnerships. Limited partnerships is a case whereby the liabilities of the business cannot be transferred to the liabilities of the owner. If, for example, I am in partnership with you and you find that maybe you are a general partner and I am a limited partner, you will find now in case of liabilities of the business, because I am a general partner, those liabilities can be transferred to me, but they cannot be transferred to you because you are limited. When it comes to a limited liability, whatever you can lose when it comes to the business is the amount of money that you invested there and nothing more. But if I'm a general partner, whatever I can lose is what I invested, plus also the liabilities of that particular business can be transferred to me. So limited partnerships are governed by the Limited Partnership Act of 1962. There's an error here, whereby we can have one or more general partners whose liabilities are limited and one or more limited partners. So note here, in a partnership kind of a business, we can have those partners whose liabilities are general, and we have those whose liabilities are limited. Those whose liabilities are limited, they cannot lose more than what they invested there. But those whose liabilities is general, they can lose their personal properties to repay the liabilities of the business. But the partnership kind of a business cannot exist where we don't have at least one general partner. There must be at least one general partner who will bear the liabilities of the business in case of a default. Now, let us go to the partnership agreement. Anywhere we have more than one person interrelating, there must be some rules to govern their conduct. That's why even in Kenya, we have the constitution which governs the individuals in the Republic of Kenya. When it comes to the schools, we have the school rules and regulations. Anywhere we have more than one individual, there must be some rules to govern the game. The same case applies to the partnership. Because we have said the owners are more than one, therefore, these two or more owners, they must have some constitution or some agreement which is documented, which guides them on how they behave when it comes to business matters. If the partners sit together and then they agree on how they are going to conduct the business in terms of how much capital each is going to contribute, how profit and losses is going to be shared, in terms of liabilities of the partners, if they agree themselves and then they document their agreement, that agreement is normally known as the partnership agreement, which must be submitted to the partners, to the governing body, to ensure that in case of any disagreement between the partners, then this is going to be like their constitution to that, so that it can solve the matter at hand. So when we say that we have got a partnership agreement, it is a contract which has got some terms, and these terms, they must be written down. It is not something verbal, it is a document. You will find that in that particular document, we are going to have some kind of agreements. As I've said, starting with the name of the firm, the nature of the business that is going to be carried out. We have the amount of capital to be contributed by each partner, the ratio in which profit and losses are going to be shared. Remember here, profit and losses cannot be shared equally. It is not a must. You can find a case whereby a particular partner has contributed more capital than the others. Because that partner has contributed more capital than the others, so he is entitled to more profit than the others. At the same time, you can find some partners are playing a role in carrying out the day-to-day activities of the partnership, where others are not involved in carrying out the business activities. Those who are active, they can be getting more profit than those who are not involved in the day-to-day running of the partnership. You also have the case of the interest to be allowed on capital. If I've invested 100,000 in the partnership, at the end of the year, I might ask for some interest for my money, which I've invested in that business. So in the partnership agreement, it must be documented how much interest one partner is going to be given at the end of the year in terms of percentage. At the same time, we can have interest on the drawings. More often than not, we can find a case whereby a partner might withdraw some money from the business for his or her personal use. That is what we call drawings in business. So if a partner takes money from the business for personal use to be returned at a future date, that amount of money can be returned with the interest. So in the partnership agreement, you must document the percentage of interest on drawings to be charged on the partners. And another thing is on the salaries to be paid to the active partners. As I've just highlighted, you might find that the business has got 9 partners. These 9 partners cannot take part in running the business, all of them. You find that maybe those who are taking part are only 3, where the remaining 6 are not taking part in running the business. These 3 who are involved in running the business on behalf of the others, they might be entitled to salary. So in the partnership agreement, it must be documented what will be the salary that is going to be paid to these active partners who are carrying out the activities of the business. Also, we can find also in the partnership agreement the terms of admitting new partners, how to expel a partner, the duration of the partnership. Those terms are normally contained there, which is now the reference point in the point of disagreement. Having noted there, we have these partners, and these partners, they must have some rights. And every partner has a right to take part in conducting the business if he or she wishes. Number 2, the partner has the right to be consulted when making crucial decisions for the business. And every partner has a right for free access of records. If I'm a partner of the business and I feel like I need to know how much was the sales for this week, because I'm a partner in that business, I have a right to inspect the books so that I can get the information that I need to know. And every partner is entitled to the share of profit equally if they have contributed equal capital and if they are all taking part in the management of the business. A partner who has contributed more than the other then should be given more in terms of the interest on capital. And a partner is entitled to be indemnified by the firm for all the acts done by him in the course of the partnership business. When we talk about indemnified here, is to be given back the money. If I'm a partner and then I have spent maybe 2,000 to conduct something that is meant for the business, so it is now the business to give me my 2,000 back because I used that personal money for the sake of the business. That is what we mean by the indemnification. And having noted that, we can now talk about other things, but you know that the rights here are containing that every partner has a right or has power of protecting the firm from any loss in case of anything, and every partner is entitled to prevent the introduction of a new partner like that. Anytime there's a new partner to be introduced, the consent must be made by all the partners. After the rights, we can look at the duties of the partner. Every partner is bound to diligently carry on the business of the firm to the greatest advantage. Here meaning that unless the agreement provides that there should be some salary, then that salary should not be provided so that the business can actually prosper. The other thing is that every partner must be just and faithful to the other partners, whereby now we should not have a partner who is maybe dishonest when it comes to the disclosure of the amount of money sold and all that. And every partner is bound to indemnify the firm for any loss caused by his willful negligence. If, for example, I'm the partner and because of my negligence, I have caused the business to lose maybe 5,000, then I'm supposed to pay back to the business the 5,000 because of my negligence. And a partner must not carry a competing business. If we own a bookshop here in town A, I cannot also open another bookshop, which is now a sole trader, whereby I'm the owner in the same town. That now I'm opening a competing business to compete with the partnership business that we have. And then every partner is bound to share losses equally with the others, and a partner is bound to act within the scope of his authority without going beyond. Having noted that, we can briefly talk about the powers of the partners. Number one, the partners have got the following powers. A, we have buying and selling of goods, receiving payments on behalf of the firm and giving valid receipts, drawing checks and and accepting and endorsing bills of exchange and promissory notes, borrowing monies on behalf of the firm, uh, and also submitting disputes relating to the arbitration, opening bank account on behalf of the firm, compromise or relinquish of any claim or portion of the claim by the firm, and withdraw of a suit proceedings filed on behalf of the firm, admission of any liability in a suit proceeding on behalf of the firm, and transfer of immovable property belonging to the firm. All those are the powers of the partner. I'll stop there, class. When I will come next, we shall look at the types of partners. Thank you.